Rising interest rates were the supposed catalyst for recent market falls. But did we really need a catalyst?
Well, some would say that markets really do need a correction every now and again. And I'm actually one of those people who believes that. I think if you go too long without reminders that markets move both ways, people start to do stupid stuff. Risk taking becomes excessive or inappropriate. In some cases, I would say we've seen a little bit of each in the last few months, and there's a reason why over time stocks tend to outperform, but they don't outperform linearly. And the reason, and that's otherwise, no one would ever invest in fixed income because it would be a foolish game, right? Why would you ever buy a bond if you could invest in this money machine of the stock market, which has no volatility and just spits out dividends at you all the time and goes up? You'd have to be a knucklehead to buy bonds. But yet they exist and the reason being historically is that equities do contain a measure of risk that fixed income doesn't, and that's why they complement each other. So did we need this? I will argue yes. Now, you hear the term, oh, it's a healthy correction. They never feel healthy. Let's be real. They never feel good. You know, they always feel better in hindsight when the market sort of resumes whatever path it's taking. And you know, certainly where we're sitting a couple of days into this most recent sell-off, it's really quite early to say whether this is the full correction, whether we've seen the end or not, and I don't want to posit that right now. But I think there was definitely some justification for it. You know, there's always the thing, what's different this time? Well, what's different this time is we've started to see the bond rates creep higher. There were various bond market gurus who were sort of keeping an eye on the 240, 250 range as being the end of the long-term uptrend in the government bond market. That seemed to be the case, and as we started to see the 10-year really start to fall out of bed, 240, 250, 260, 270, 280, et cetera, that started to weigh on the stock market. One of the things you've heard from people all along is there's no alternative. I've used the term TINA and FOMO various times here and elsewhere. But at some point, you do start to have an alternative. I don't know that 280 on a 10-year Treasury bond is necessarily the credible alternative, but it starts to look a little better, especially if you're getting a little vertigo in the stock market. I would say that the rally we saw in through January was, in hindsight, felt like a blow-off. It kind of felt like it at the time, but it certainly in hindsight feels that way. And that's the kind of thing that tends to need a correction, because that's when the valuations get extreme, people's positioning gets extreme. And I think that was more the bigger cause here. It was not necessarily valuations, but positioning getting extreme, people getting too inured to the lack of risk. And the markets have a nasty way of reminding you about risk from time to time. Going forward, where does this lead? There was the taper tantrum a few years ago, and the Fed sort of backed off at that point, but there's a very different element at work here. In both cases, you have the Fed trying to unwind an unprecedented monetary stimulus, both in terms of size and in terms of mechanism. They've never done it before, and they've never done it this big before. And when I say that, I'm including all the global central banks. Well, how do you unwind something like this? And nobody really knows, and people have a very good right to be fearful of that. What's different this time is you've added fiscal stimulus on top of it. The tax reform package certainly is providing a measure of fiscal stimulus, at least to many of the large corporations, in a way that hasn't been seen before. For years, federal bank, the Federal Reserve people, whether it was Bernanke or Yellen, were advocating for some help from the fiscal side to kind of help their mission out. And they didn't really get it, except for some in 2009 when the economy was extraordinarily dire. Now, several years later, you've got the economy, if not chugging along optimally, it's chugging along pretty well, and now you've thrown fiscal stimulus on top of a late cycle economy at the same time that the Fed may be trying to unwind. There's a lot of moving parts in there. Perhaps perhaps the fiscal stimulus offsets the Fed, or perhaps the Fed needs to offset the fiscal stimulus. But all that is adding up to the market really having a difficult time of assessing what's going to happen going forward. The euphoria of, oh, let's raise our earnings estimates, which is what you saw and did power the rally. And yes, the market is powered by earnings and dividends. But that's behind you now, and markets are starting to discount the future. What does that mean? They've digested the earnings estimates, and now you're looking at this monetary and fiscal situation where you have, at the worst scenario, you can argue that there could be stagflation, that the Fed is forced to raise rates to combat labor market and commodity inflation. That's still all unresolved, but I think the markets as a whole, stock and bond, are forcing themselves to reckon with that.